Hi, I'm Jeff Tucker, Principal Economist at Windermere Real Estate, and these are the numbers to know right now. We now have over a full month of data to see how 2025 is shaping up, and so I wanted to focus today on one of my favorite leading indicators, inventory. So the first number to know this week, 25%. That is how many more active listings there were this January compared to January 2024. For a sense of scale, it was about 829,000 active listings this year compared to only about 666,000 active listings last year. And in fact, we're now only about 13% below January 2020 levels, which was the eve of the pandemic. That is a huge milestone the housing market is approaching after really being defined by low inventory for the last few years. Now, there's a ton of data in this graph, so much that it actually makes it a little hard to read. So I'll try highlighting a couple sections at a time. So here's what happened early in the pandemic. Inventory plunged. First, because sellers weren't even sure about selling in the early pandemic, and then because demand actually took off, fueled in part by lower interest rates, as well as booming demand for more space and maybe the chance to work from home. So ultimately, just over a year later, by May 2021, for instance, we had 62% fewer active listings than in May of 2019. So that helped fuel some extraordinary price appreciation and really frenzied competition in the markets for about a year. Then in mid 2022, interest rates shot up from those record lows of around 3%, and in fact went above pre pandemic levels to the highest in a generation, which helped put the brakes on homebuyer demand for a while. That has slowly helped inventory build back up toward normal levels, and that's about where we are today. Now, what does higher inventory mean for the market? Well, it should restore some balance between buyers and sellers, putting a damper on home price appreciation, helping homes sell a little slower on average, and giving buyers more variety of choices and a little more negotiating power. So all of that means the market is shaping up to be a little friendlier for buyers this spring than in recent spring buying seasons. So this is what that data looks like in year over year growth terms, up 25% in the most recent data. And if we check in on pending sales of how many transactions are actually occurring early in the year, they're only up 2% year over year in January. So that Q4 home buying burst has not really kept up in the new year, probably because interest rates came back up to around 7%. The next number to know right now, 3%. That was the inflation rate as defined by the year over year change in the consumer price index in January. As a reminder, the Fed is aiming for inflation of just 2%. So this figure is still running a little too hot. Now, this is just one data point, but stubborn inflation is one reason why the Federal Reserve did not opt to cut their short-term interest rate again at their most recent meeting. They're taking a wait and see approach to see how inflation continues to develop and to see how the labor market and the rest of the economy is doing in the new year. So speaking of interest rates, our last number to know right now is a little less than 7%. That's where interest rates have moved recently, giving a little bit of relief to home buyers, but that's still probably feeling a bit high for many folks. I think some gradual further declines are possible, but certainly not guaranteed. And really big declines seem especially unlikely anytime soon. All right, that is all for this week. Thank you so much for watching.